If you build financial models, you already know that forecasting revenue is not optional. The real question is which method actually fits the business. In this video, I'll break down 5 revenue forecast methods, how each one works, when to use them, and how to build them into your model. And stick around because the last one, a driver-based forecast, might be the difference between a disconnected top-down model and a forecast that actually drives decisions across teams. Let's get into it. Let's start with the most straightforward approach, historical trend. This one is exactly what it sounds like. You take past revenue, identify the growth pattern, and project it forward. If you've grown at a steady rate, let's say 10% quarter over quarter, you extend that into the future. Quick example. Q1 revenue might be 100K, Q2 110K, Q3 121K, and that's consistent 10% growth. So Q4 would forecast at 133K, Q1 next year at 146K, and you just keep going. It's fast, requires almost no inputs, and it can work well when the business is stable, like established SaaS company with low churn and steady acquisition, for example. But here's the catch. This method assumes the past is a good predictor of the future. And that's a very dangerous assumption if you are in a changing market, dealing with seasonality, launching new products, or shifting your model. It also doesn't explain why growth happens, which makes it hard to stress test or adjust. So use this as a baseline forecast. It's helpful for sanity tests or initial drafts. But if you're presenting to stakeholders or building an operating plan, you want to go deeper. The second method, market analysis. Market analysis forecasting flips the script. Instead of starting with past performance, it starts with the potential, the total size of the market. It's especially useful if you're launching something new, entering a different segment, or planning for scale. Here's how it works. We start with TAM. TAM stands for Total Addressable Market. That's the full demand for your product or category. Then you narrow down to SAM. SAM is the Serviceable Addressable Market, based on what you actually can serve given your product and your distribution. Then, from there, you estimate SOM. SOM is your serviceable, obtainable market. That's what you are realistically think you can capture, based on your go-to-market, competition, pricing, and all of that. A real example. Imagine you're building a vertical CRM for real estate agents. The global CRM TAM might be 60 billion, but your SAM, real estate professionals in the US, is closer to 2 billion. With your current go-to-market, you think you can realistically win 0.5% of that. That's a 10 million SOM. From there, you project how quickly you grow into that share. Maybe 1 million in year 1, 3 million in year 2, and so on. This method forces alignment between ambition and reality. It's great for top-down planning and investor decks, but you will need more detailed method for actual operations. Method 3, customer segmentation. Customer segmentation forecasting is about recognizing that not all revenue behaves the same. Different segments contribute differently to the revenue profile and to your risk. Instead of treating all customers as one block, you break your model into logical groups by product line, by region, by price point, by acquisition channel, whatever makes sense based on how your business operates. Here's a clear and simple, very simple example. Say you run a subscription analytics tool and your customers fall into two groups, startups and enterprise teams. Startups comes in through self-serve. They pay $49 a month and they turn around 10% a month. Enterprise go through sales. They pay $2,000 a month and they have 95% annual retention. If you forecast both together, the signal gets muddy. But segment them and suddenly your model can tell you two different stories. Self-serve drives volume, but revenue is fragile. Sales-driven accounts grow slower but compound over time. This lets you focus on what's actually driving growth and where the forecast risk lives. Segmented forecasting takes more effort, but it's especially powerful when your customer base is evolving or diversifying. The fourth method, sales funnel. Sales funnel forecasting is especially relevant for B2B, where revenue depends on a structured sales process. You're not guessing here. You're working with actual pipeline data, leads, stages, close rates, deal size, and velocity. The idea is simple. Break your funnel into stages, say lead, qualified, proposal, closed, and assign probabilities and average values to each. For example, you have 200 leads. 30% typically becomes qualified. 20% of those receive a proposal, and 25% of those close with an average deal size of, let's say, $15,000. Run the math. 200 leads, 60 qualified, 12 proposals, 3 closed deals, 3 deals times 15,000, 45,000 in forecasted revenue. You can also layer a cycle time, how long it takes for deals to move from one stage to the next, to forecast revenue timing, not just totals. The strength of this method is that it's data-driven and highly operational. It connects directly to sales activities. It gives you levers to pull more leads, better conversion, faster velocity, but it's only as good as your pipeline hygiene. Garbage in, garbage forecast. Use this when sales drives your growth and you want forecast that reflects what's actually happening on the ground. And lastly, the driver-based forecast. Driver-based forecasting is where strategy meets execution. It's not just about projecting revenue, it's about modeling how the business actually works. Instead of starting with a revenue number, you start with real inputs that drive it. For a coffee shop, for example, that might be how many people walk in per day, how many days you're open, how much people spend on average. You take those numbers and you build your forecast from the ground up. Here's a simple example. Let's say you get 100 customers per day. You're open 30 days a month and each customer spends about $5. That gives you 100 times 30 times 5, which brings to $15,000 in monthly revenue. Now, if you want to grow, you can focus on real things. Can we get more foot traffic? Can we upsell or raise prices? Can we add delivery or breakfast menu? This is a simple example, but the driver-based budget can apply to so many different businesses. The point is, once you know the real levers behind revenue, you can forecast with clarity and act with purpose. A good driver-based forecast doesn't just tell you what might happen, it tells you what to work on. If you're finding this valuable, hit like and subscribe. It really helps more people find this kind of content and you get to know right away when I publish more videos like this. Now, here's the cool part. In every single example we just walked it through, whether it's a coffee shop, a retail store, a consulting firms, you end up with one number, total revenue. And once you have that, the next step is plugging it into your financial model. That means connect it to the income statement, making sure it rolls into the cash flow and ultimately lands in your balance sheet. If you're not 100% sure how to do that or how to keep everything linked and balanced and dynamic, I made a video that walks you through the full process step by step. It shows exactly how to connect schedules, how to flow assumptions into forecasts, and how to keep your balance sheet balanced the whole way through. So if that's the part you're working on now, I'll see you there.